Good afternoon, ladies and gentlemen. I'm Raymond Dahlman. I'm the host of the Weekly Economic Update and the Liberty Call. Hope everyone had a fantastic weekend out there. It's snowing again here in Colorado, so we had a pretty nice weekend. Although I didn't go out too much, I pretty much had my ass parked on the couch watching college basketball all weekend. So that was my primary duty. Cougs won. Woo! They're headed to the Sweet 16 in San Antonio. They'll be playing Thursday. It's the second game of that slate. So I think it's around 7 or 8 o'clock. 7-ish Mountain Time, 8 o'clock-ish Central Time for my Houston folks. So that's certainly some good news. They had a bit of a tough game yesterday, but pulled it out. And, all in all, pretty good. It's a lot of what's the word? A lot of Cinderellas made it through the weekend. So St. Peter's, I'm not even sure where they're from, the Peacocks, and let's see, but a bunch of number 1s and 2s went down. Unfortunately, not in the bracket that the Cougars are in. They got to play Arizona on Thursday. So, and Arizona had a tough time with TCU last night. So, anyways, I know you didn't come here to get your college basketball fix. But hey, it's one of my favorite things, so I figured I'd talk about it for a minute. So, all right, let's see. If it's your first time watching, please click on there's probably a subscribe button, probably right about there, and give me a thumbs up and a share. I'd greatly appreciate it. So, all right, well, let's go ahead and jump in and see how the markets did today before we get into the weekly update. The Dow Jones was down 0.58%, closing at 34,552. S&P 500 down basically flat, down 0.04, closing at 4461. NASDAQ down 0.4, closing at 13,838. Small caps are down almost 1%. The VIX was down 1.26%, closing at 2357. It was up earlier today. All right, let's look at the other exchanges here, exchanges here in the Americas. Looks like Canada was up. Brazil was up, Mexico was up. Getting into Europe, Western Europe looks kind of mixed. Germany was down, UK was up, France was down, the euro was down, Netherlands up. Again, most of these are up 0.5%, down 0.5%, so they're nothing too major. Russian markets still closed. And then we get into the Asian markets. Looks kind of mixed, nothing too major. The Chinese markets pretty much flat. Everything was pretty much flat, from the way it looks in the major exchanges out there. So, for trading day, March 21st, kind of just meh, I guess, if that's a technical term out there in investment world. So, all right. Well, that's certainly not the worst news that we've could have right now. So, all righty, let's go ahead and jump into the weekly update and go through this real quick. All right, week on Wall Street with the Fed embarking on a new course of monetary tightening amid continued fighting in Ukraine. Stocks staged a powerful broad-based rally last week. The Dow Jones Industrial Average jumped 5.49%, while the S&P gained 6.16%. NASDAQ soared 8.18%, and internationals were up 5.17%. Stocks roar after surrendering gains on Monday. Stocks surged higher for 4 consecutive days. The rally was propelled by strong economic data, the outcome of last week's FOMC meeting, and reports that Russia made interest payments on its sovereign debt, avoiding a technical default. Well, let me stop right there. What happened with us? What happened with the Russian being able to make payments on its debt? That was actually facilitated by a U.S. bank. I believe it was J.P. Morgan. So I heard someone read the article yesterday, and I'd have to dig around and find it. But just some interesting, if we're not supposed to be doing business with Russia, we did help them out by allowing them to make an interest payment. I believe it was denominated in dollars. So we'll see what happens with that. All right, jumping back in, the uptrend began with A drop in oil prices and a lighter than expected wholesale inflation report. Stock prices initially buckled following Wednesday's hawkish FOMC announcement, but turned higher as investors interpreted the Fed's news as a welcome plan to combat inflation. Stocks extended their gains into the final two trading sessions, cementing their best weekly performance since November of 2020. The Fed's plan: for the first time since 2018, the Federal Reserve hiked the federal funds rate, increasing it by 0.25%, and signaled that it expected to raise rates at a faster pace than originally outlined in December. Based on its projections, the future Fed funds rate, the Fed may implement 7 quarter-point rate hikes this year and another 3 to 4 next year. In a statement following the FOMC meeting, Fed officials expressed rising concerns over inflationary pressures made more acute by the war in Ukraine. Members also indicated that they would soon announce a plan to reduce the Fed's $9 trillion balance sheet. So, all right. So economic data coming out this week. Wednesday, we have new home sales. Thursday, jobless claims, durable goods orders, and the PMI composite flash. Friday, consumer sentiment. We have 3 companies reporting earnings this week. Today on Monday, we have Nike. Tuesday, Adobe. And Wednesday, we have General Mills. All right. So kind of a light week as far as, economic data that's coming out and companies reporting earnings. So, I think there was a lot of exuberance that the Fed actually did something last week. And, the other economic news was fairly good. But, we'll look at the stock chart in a second. And I think we'll see that it was not all that great. So let's go ahead and bring that up. If you remember last week, this is the Dow 30. I was, pointing out that every time we've had a run up in the market, we seem to hit a line of resistance and we have a retracement. Same thing again today. I guess I am clairvoyant. If you were watching Friday's video, you probably saw me say, well, I think it's probably going to go back down this way. And here's why. If it broke through this line of resistance, that would be a sign that, we're in more of an upward trend or heading towards an upward trend. And maybe, bear markets and recessions are, not in our future. But, just based upon everything that's going on, I don't even have it up on the screen. So, duh, idiot. Here we go. Let me show you again. So, as you can see, came up, and then bounced off this. And then we had a down day today. Again, it repeats the same situation we had at the beginning of February. Same thing. Then we had another downward trend. Same thing in January. So, it seems to be repeating this over and over again. But unfortunately, the high points are lower than the previous high points. So, again, that's why I, looking at all the things considered, I would, I personally see that. We're heading towards recession, slowdowns, whatever you want to call it. The markets are going to have to recalibrate after all of the, new money that was put into the system over the last 2 years. So, some things will go up, some things will go down. But I think the bigger trend is that as of right now, over the last, 2.5 months, we've been in the downward trend, and I would expect that to last a little bit longer. So, all righty, let's go ahead and get rid of that. And all right, so I got 3 articles I want to breeze through. The first one comes from John Malden. I got this on Saturday in my email. It's part of a subscription I participate in. It's titled Brace for Recession Impact. So I'm not going to read all of it. It's a pretty long article. I do have it linked in the show notes. So if you want to read through it at your leisure, please feel free to do. He's a fantastic economist, trader. I'm not sure what you really call him. But hell, he's got 20 or 30 years more experience than me at this. So I always welcome his opinion on things. So, all right, let's go ahead and dive in. The strange recession we are now entering is strange for another reason besides those I described last week. The last, quote, normal recession ended in 2009, almost 13 years ago. As with most unpleasant experiences, we don't put a lot of energy into remembering what it was like. The problem is we need to remember it in order to prepare for the next one, which is now upon us. Today, we'll remind ourselves of what happens in a typical recession, both to the economy and to the financial markets, and we'll also look at some of the ways this one probably won't be typical. It certainly has the potential to be worse. This week, we saw some volatility, the good kind, as stock prices recovered and oil retreated a bit. The basic facts haven't changed, though. recession was already a strong possibility even before the shooting started, and the genie is out of the bottle even if the shooting stops. The Russian sanctions will continue, which means global realignment will continue too. According to the National Bureau of Economic Research, the referee of such things, a recession is a significant decline in economic activity spread across the economy lasting more than a few months. That's a good definition, but still leaves room for interpretation. What is, quote, significant? And how many months are a few? My friend at Investopedia points to 4 specific markers of recession. Loss of jobs, declining real income, production and manufacturing slowdown, and lower consumer spending. The total number of non-farm jobs was steadily growing until the brief COVID recession fell hard and still hasn't fully recovered. It has been making good progress, though, as you can see here. Is this the, yeah, you can see the jobs we had here. Let me make this a little bigger so you can see it. So you can see where we were at about 152,000 persons that were employed. And we dropped way down to around 130. And so we still have this gap of the employed Americans here currently. So, and then again, you can see on the longer term trend going back to the 40s that typically at the beginning of a recession, we hit a peak, and then the job market it takes several years to recover. As you can see here from this little tiny recession that we had, we still haven't gotten back above where we were 2 years ago. All right. A longer term look at the same data shows employment trends tend to peak just as recessions, the vertical gray bar lines, begin. But notice since 1940, smaller, since 1940, every pre-recession peak was higher than the last pre-recession peak. If the same doesn't happen this time, we will have yet another reason to call this recession strange. Unfortunately, I think that scenario is possible. Today's higher energy prices and war-related disruptions will start to bite soon. Businesses who are desperate to hire right now will see slower sales and stop adding staff. That's the first step in reducing staff. As for the second marker associated with recessions, declining real income, it's already happening. But here again, it's a strange picture. Let me make that bigger for you to see. So you can see, real income, and then you see these huge spikes that were due to the stimulus payments over 2020 and the beginning of 2021. But you do see if without those, we would be on a fairly normal trend, but it is starting to decline here in the last few months. So, that is something to worry about. All right. The chart shows income popping sharply higher in 3 peaks, which correspond with the 3 COVID stimulus bills. If you extrapolate the pre-COVID trend forward, today's level is about where it should be, but it's been declining for several months despite higher nominal wages, partly due to rising inflation. But whatever the cause, people change their behavior when they perceive it becoming steadily harder to make ends meet. Consumer sentiment surveys have been showing sharp drops, likely due to rising prices caused by supply chain issues and inflation. Marker 3, a manufacturing slowdown, is harder to measure with COVID and supply chain problems in the mix, but it seems almost certain to decline as the war makes components and materials even harder to obtain than they are now. All right, let me get back down here. And the fourth and last effect is lower consumer spending. This is also murky because the spending mix matters a great deal. When people have have to spend more on food, fuel, and utilities, they have less to spend on other things. We saw with COVID how these shifts can devastate certain sectors. A non-COVID recession will look different, but may not be much better. All right. And down here, this table shows the maximum drawdowns during major recessions since World War II. The 2001 and 2007 bears were particularly ugly, and you can see that, going back in the 40s and 50s, you had 20 or negative 21, 15, 21, 28. And as we get closer to more modern times in 73 and 75, we had a 48% retracement. 2001 was 49%. 2007 was 57%. And then just 2 years ago, it was 34%. So the average is about 30% in a decline. Based upon the more recent ones, I personally am looking at maybe a 40 to 50% drawdown. But again, time will tell. Massive QE helped the stock market recover in 2020 and 2021, noted below by the extraordinarily high correlation between stock prices and quantitative easing beginning in March, on March 23rd, 2020. So again, you can see the massive spike with the quantitative easing. It jumped, market jumped along with it. All right. The best way to play a recession, in my opinion, is to view it as a buying opportunity. That means hold cash and look for value. The tricky part is you never know where the bottom is. So today's value could be an even a bigger value next week. That's frustrating, but inevitable. And hopefully you're not buying to sell next week anyways. Better to get a good price and sell in the next bull market when it's absurdly overpriced. And make no mistake, I fully believe there will be another bull market. It may just not have the rocket fuel of quantitative easing for several years as the Fed continues to fight inflation. Right. Lengthy transition. Everything I said to this point is the conventional recession scenario, but we already know it isn't. This one isn't conventional. I don't expect it to look like 2000 or 2008 at all. A better analog is to the 1970s stagflation era. That was entirely different world, certainly, and certainly different kinds of markets. There were no ETFs back then. Mutual funds were a new idea, and the 401k hadn't been invented yet. Online trading was science fiction, so it's hard to visualize what kind of recession will combine with today's kind of markets. We haven't seen anything like it. I keep saying this, but it bears repeating. Most recessions are deflationary events. Consumer prices decline as growth weakens. That's one of the qualities that makes them bearable, though not pleasant. Your income falls, but so do your living costs. Stagflation is not like that. Your income falls while your living costs rise. In this case, due mainly to higher energy costs. We will see this directly in fuel and energy utility bills, and indirectly in many other expenses. In some respects, it will be like a value-added tax tacked onto prices at every level of production. But this is hardly a tax reform. All the usual taxes will continue at current rates, if not higher. Then we'll have the new energy tax on top of them. It won't matter what Congress does or how you vote. The tax will be here, and you'll have to pay it. Larry Summers wrote a particularly somber Washington Post op-ed this week, gruesomely titled, "The Fed is Charting a Course to Stagflation and Recession," end quote. Only a few weeks ago, he was talking about how difficult the choices facing Jerome Powell would be. Now he feels the choices they're making will have very ugly consequences. I'm going to quote a few paragraphs, but but the entire piece is worth reading, and it's linked here in the notes somewhere. Yeah, there's a hyperlink for it. Anything is possible, and wishful thinking can sometimes prove self-fulfilling. But I believe the Fed has not internalized the magnitude of its errors over the past year. It's operating with an inappropriate and dangerous framework and needs to take far stronger action to support price stability that appears likely. The Fed's current policy trajectory is likely to lead to stagflation, with average unemployment and inflation both averaging over 5% for the next few years, and ultimately a major recession. Powell has emphasized his admiration for Paul Volcker recently. Current inflationary conditions are not as bad as those Volcker inherited as Fed chair in 1979, but they are worse. But they are the worst since then. To prevent inflation from metastasizing, Powell and his colleagues need to be absolutely clear on two propositions that Volcker took as axiomatic. First, price stability is essential for sustained maximum employment, while overheating the economy leads to stagflation and higher levels of average unemployment through time. Second, there can be no reliable process against inflation without substantial increases to real interest rates, which mean temporary increases in unemployment. Real short-term interest rates are currently lower than any point in decades. They will likely have to reach levels of at least 2 to 3% for inflation to be brought under control. With inflation running about 3%, this means rates of 5% or more, something markets currently regard as almost unimaginable. Think about it for a moment. Summers knows full well what such a policy would mean to the economy, but he, and I agree, feels letting inflation get out of hand is an even worse option. The current go slow 25 basis points per meeting plan may have the desired effect on not spooking the financial markets, but it will also let inflation expectations increase and lead to wage and price spirals. I can't emphasize enough how dangerous this particular environment is. In fairness, numerous economists and analysts believe Powell has everything under control. I do not. And will taper the balance sheet more than expected. I hope they are right. My belief is that the Federal Reserve made its major monetary mistakes well over a year ago, arguing in August of 2020 that letting inflation run hot wouldn't be that bad. Well, now we see that it is. That inflation would be transitory simply brings up the ghost of Arthur Burns. Combine inflation with supply chain issues plus war-related energy and food shortages, and we have a very volatile mixture. Eventually, inflation will be brought under control, and we'll be back to deflationary environment under the weight of a heavy debt load. But the current path the Fed is on could mean eventually is more than a few years. The saying in uncertain terms is hope for the best and plan for the worst. I certainly hope war ends quickly, though some series of events that bring Russia back into the global economy quickly, I don't anticipate it. I think we are transitioning to a new era, and the transition could take some time, not months, but years. Here in the US, we aren't feeling much of the pain. We will. We are entering an extended period of sharply higher energy and food prices, which will raise the cost of everything else. Add to it the shortages we will see in commodities that enable our electronic devices and infrastructure, and higher financing costs as the Fed raises rates and may well overshoot. It's going to be difficult, but it will also bring opportunities, which I'm excited to explore. I do believe in the American entrepreneur and the future of marvelous technology. So, buckle up, buttercups. It is going to be a volatile ride. And, my man John here seems to agree with me. Well, I seem to agree with him. He's got a lot more tenure in this business than I do. But it's going to be rough. All right. Next article I got here is from First Trust Advisors, from Brian Westbury, their chief economist. It's titled, What the Fed Should Do. Normally, when we write about public policy, monetary policy, taxes, spending, trade, and regulations, we mainly focus on what we think policymakers will do and the likely effects on the economy or other financial markets. For example, we now think the Fed is on a path to raise rates gradually and persistently through 2022, with some possibilities of a rate hike of a half percentage point along the way as well. But this is a far cry from what we think the Federal Reserve should do. The Fed is well behind the curve, and in spite of raising rates by a quarter of 25 basis points last week, it's only getting further behind in its fight against inflation. Yes, a higher target short-term rate is an improvement in policy, but that's because it's falling behind the inflation curve at a slower rate, not because it's actually catching up. At present, the futures market in federal funds appears split roughly 50-50 on whether the Fed will raise rates by 25 or 50 basis points in May. Instead, we think the Fed should raise short-term rates to 2% and do it immediately, like today. I agree with Brian here. In addition, the Fed should announce that the hurdle for an additional change to rates in the next 6 months is high, and it will reduce its balance sheet by $100 billion per month, starting as soon as possible, not only by rolling over maturing securities, but also by outright selling longer-dated securities. That pace would double the peak pace of quantitative tightening from the prior cycle back in 2017 through 19. No, we are not being cavalier about these suggestions, nor are we making them to get attention. Instead, it's the Fed that's been cavalier about inflation risk and now has the financial markets and economy in a position where we have to obsess over its every move. Consumer prices are up 7.9% in the past year, and the year ago comparison will likely peak somewhere around 9% in the next couple of months. The M2 measure of the money supply has grown more than 40% since COVID started and signals persistently high inflation for years to come. Yes, we are well aware that the Fed not having prepared the financial markets for a sudden move to 2%. There may be some temporary significant losses for some investors, particularly in equities. But once digested, we think this dramatic move in monetary policy should be good news, whether you're a hawk or a dove on monetary policy. If you're a hawk, the attraction is the obvious. The Fed is finally on the ball and more likely to get inflation under control. But we also think a dramatic move in policy should appeal to doves. Even the most dovish policymaker at the Fed is forecasting a short-term interest rate of around 2% in late 2023 and late 2024. Getting to 2% more quickly might open the door to staying there or above for a shorter amount of time. It is also important to note that the median policymaker at the Fed expects the short-term interest rate target to average about 2% for the next 3 years. In other words, the Fed would just be placing the short-term rate right about where it'll be anyhow, and then taking the next several months to assess where it needs to go next. We think after pausing for several months, the Fed would eventually realize it needs to do more. But if we're right, it means by having swiftly proceeded to 2%, the Fed would have less work to do than if it were gradually meandering rates upward over the next several months. A target rate of 2% would not only be high by historical standards, it would still be very low relative to current inflation and even low versus the future inflation expectations embedded in the prices of Treasury securities. Raising the short-term rate to 2% would not invert the long end of the yield curve. The 10-year Treasury is yielding 2.2% as of Monday morning. There is time and place for gradualism in monetary policy, particularly when the unemployment rate is still above normal or when inflation is a little above the Fed's long-term target. This is not the time and place. The Fed's monetary policy mistakes over the past 2 years have accumulated to a point where they equal those of the 1970s. Small policy shocks today will save us from even bigger ones down the road, but it takes intestinal fortitude. Well, Brian, I think the problem is there that people in government lack courage and they just want to keep their jobs and they're a bunch of cowards. So that's my opinion. All right, more good news. Crude, and I'm saying that sarcastically. Crude settles up more than 7% as EU mulls Russian oil ban. It's written by Marcy DeLuna from Reuters. Oil prices settled up more than 7% on Monday, with global benchmark Brent climbing above $115 a barrel as European Union nations disagreed on whether to join the United States in a Russian oil embargo after an attack on Saudi oil facilities. Brent futures settled at 115.62 per barrel, up 7.69 or 7.12%, while WTI crude settled at 112.12 per barrel, up $7.42 or 7.09%. Such an embargo, quote, could be the precipitous for global trouble supply-wise, said John Coldiff, a partner at Again Capital LLC. Given the uncertainty about the EU's potential ban of Russian petroleum imports, U.S. gasoline futures jumped 5%. European Union governments will consider whether to impose an oil embargo on Russia over its invasion of Ukraine as they gather this week with U.S. President Joe Biden for a series of summits designed to harden the West's response to Moscow. The EU and allies have already imposed a panoply of measures against Russia, including freezing its central bank assets. Ukraine defied a Russia demand that its forces lay down arms before dawn on Monday in Mariupol, where hundreds of thousands of civilians have been trapped in a city under siege. With little sign of the conflict easing, the focus returned to whether the market would be able to replace Russian barrels hit by sanctions. Quote, optimism is seeping away about progress in talks to achieve a ceasefire in Ukraine, and that sent the price of oil on the march upwards, end quote. Susanna Streeter, senior markets analyst at UK-based asset manager Hargraves Landau. Over the weekend, attacks by Yemen's Iran-aligned Houthi group caused a temporary drop in output at a Saudi Aramco refinery joint venture in Yanbu, feeding concerns in a jittery oil products market where Russia is a major supplier and global inventories are at multi-year lows. Saudi Arabia on Monday said it would not be responsible for any global oil supply shortages after these attacks, in a sign of growing Saudi frustration with Washington's handling of Yemen and Iran. The latest report from OPEC and its allies, including Russia, together known as OPEC Plus, shows some producers are still falling short of their agreed supply quotas. So, all in all, things aren't looking real good right now. So fill up your gas cans, fill up your gas tank, make sure you have ample food supplies. If there's some sort of a supply breakdown, get some bags of rice and beans, things that you can store for long periods of time. And anyways, so not that I think it'll get that bad, but you just always want to be prepared. It's like hurricane preparedness. Growing up on the Gulf Coast, you always had to have flashlights and batteries, some extra water, things like that. So anyways, all right. Well, hopefully I didn't bring anyone down too much, but that's the news of the day. So hope everyone has a fantastic week. I'll be back tomorrow with Tuesday's Liberty Call, and I'm off to some meetings for the evening. So hope everyone has a great day, and I will be back tomorrow. Bye-bye.